So now let's turn our attention to the short side of the equation, which is selling at the rally on the downtrend. So again, very specific entry rules for going short would be number one, looking at the S&P 500, ideally we're going to go short on stocks when the S&P overall market is bearish. Again, we look at the S&P below the 20 EMA and ideally the 20 EMA below the 50 moving average. So that happens when the market's on a downtrend, when it's in a bear market, and that's the ideal time to short stocks. So for the particular stock, in this case, for example, SCCO, we're looking for a clear downtrend. So price making lower highs and lower lows with moving averages in the downtrend sequence. So we want to see the 20 EMA below the 40 EMA. You can see over here, the red dotted line is the 20 EMA below the 40 EMA, and the 50 MA below the 150 MA. So the blue line, the 50 simple moving average, below the 150 simple moving average. This condition must be met, or at the same time, the price could also be below the 200 moving average, which is the red line over there, and the 200 is sloping down. So either one of these conditions must be met together with the 20 below the 40 EMA. So once we've got a clear downtrend, we are looking for the price to rally and to bounce off a moving average resistance. So we want to see it finding resistance at one of the simple moving averages, the 50, 100, 150, or 200. So in this case, you can see the price rallying and finding the resistance at the 50 moving average, right? So very, very clear resistance over there. Next, we want to ensure that that moving average has been recently tested to be a strong resistance. So over here, we will only enter if we see it's been tested before over there. We could enter here if it's been tested over there before, right? So we need a recent test to be convinced it is strong resistance. So once we see it hitting our moving average, when do we enter the trade? In this case, we wait for a bearish candle to appear following a pivot point. Now recall, in the long setup, the pivot point was a V shape going down. When you're going short, the pivot point is a V shape in this direction, all right? So in other words, this could be the moving average like that. This is a 50, for example, and the price goes up, hits it, that's one test, comes down, and it's going up again. So again, as it goes up, you see a series of these candles. Okay, and what you want to see is you want to see a bearish candle, like so, a red candle, followed by the pivot point. So can you see where's the pivot point in this case? So in this case, this is the pivot point. This high is the pivot point because the pivot point on the short direction is the highest point, which means it makes a higher high than the previous candle and a higher high than the next candle. So that's a pivot point. So once you've got a pivot point, you need to see a bearish candle to take the short trade. If it's a bullish candle, you got to wait for a bearish candle to appear. Now, at the same time, if we have got a bearish pin bar or a bearish engulfing pattern, that would be a bonus. Not necessary, but it would be a bonus to have. At the same time, you want to see downtrend momentum. So we've got 3 indicators, and we want to make sure that at least 1 out of 3 of the indicators is showing us a bearish signal, either the parabolic SAR or the MACD or the force index. So with those rules in mind, let's take a closer look at this chart. There we go. All right, so we have got SCCO. Do we have all the conditions met? First, do we have a clear downtrend? Yes. Why? 20 EMA below 40 EMA, 50 moving average below 150. There we go, downtrend sequence. We need to see the price rallying and hitting one of the moving averages and finding resistance. So in this case, the price rallies up and finds resistance at the 50. Okay, has it been tested before? Yes, over here, it was recently tested. So test one, and that is a valid entry. Now, I wouldn't say it's a valid entry yet, but there's a valid resistance. Okay, now question, would we enter after this bearish candle? Now, again, notice that's the pivot point, right? That's the pivot point. We've got a bearish candle. Could we take an entry? Not yet. Why? Because, again, notice the parabolic SAR is still bullish. The force index is bullish, and MACD is bullish. So we want to wait for one of them to turn bearish. So when does it turn bearish? There we are. So over here, force index crosses bearish right as we see this bearish candle. So this bearish candle confirms the short setup because it's when the force index turns bearish. There we go. Okay, great. So once we've got that, we can place our sell order and our stop loss to protect ourselves, and we're going to ride the trend all the way down. So once the setup is confirmed, we place our entry and stop loss, and if you want to a profit target as well or no profit target, ride the trend down. Okay, so for short setup, our entry would be a sell order. All right, so we put a sell stop limit order 1 to 10 cents below the low of the bearish candle. All right, so again, I've mentioned it before, 1 to 10 cents depending on the price of the stock. So in this case, it's a $40 stock. We could use 3 cents. All right, so that's our bearish candle that confirms the short entry, and we place the stop loss. We place our sell entry or sell order right below that candle, right? So in this case, you'll be somewhere at about it's about $42, 42 something plus, right? All right, so where do we place our stop loss? Similarly, we place our stop loss above the moving average with a bit of buffer. So in this case, we'll place our stop loss 1 ATR above the moving average resistance. Again, you have to calculate the ATR using FinVis or using the indicator. So we measure 1 ATR. So for example, it could be $1 in this case. So the stop loss would be $1 above the moving average. That would be our stop loss. And again, for going short, notice the stop loss is a buy order. And it'll be somewhere at about 45.50, thereabouts, somewhere there. All right, I've got the exact numbers on the next slide. Okay, so what's the distance from your entry to your stop loss? Right, that is called your 1 hour distance. So in this case, it's about $3. Thereabouts, $3 is your 1 hour distance. Okay, now again, ensure your stop loss is above the recent swing high, whichever is a higher point. So where's the recent swing high? Well, the recent swing high was actually over here, right? That's a swing high, that's a swing high. So our stop loss is safely above that, so that's fine. All right, if it is not, we can always shift it up above the recent swing high. So again, we could place a fixed target price of 2R. Right, so again, I'm going to show you that on the next slide. So the target price would be somewhere over there. Or we can not place a fixed target price. We can merely stay in the trade and exit only when the 20 EMA crosses back above the 40 EMA, showing us a new uptrend. So let's take a closer look at how that works. All right, so there we go. There's a closer look. So again, our entry is over here. That's our sell stop limit. In this case, we're selling at 42.49. Our stop loss would be above the resistance by 1 ATR, that'd be 45.14. And again, our 1 hour distance would be 265. That's our risk per share. And again, we can put our profit target at double the risk. In this case, be 530. Multiply this by 2, get 530. You take 42.49 minus 530. The profit target would be at 37.18 thereabouts. All right, so we enter over there. And again, once it hits the profit target, we could take our profit at 2R, call it a day. Or again, you could not have a fixed target price. So if it continues going down, you stay in the trade and ride the trend all the way down to maximize your profits when you catch a strong trend. And you can exit when the 20 EMA crosses back above the 40. So the new uptrend, you exit. Now, similarly for the long setup, as it goes down, we could also protect our profits. So again, it says as the stop loss can be lowered to your entry price and above subsequent pivot points to protect your profits as well. So again, what we're saying is the moment you enter this trade and it moves down in your favor by 1R, 265, you can then shift the stop loss down to your entry price. So now you've got a risk-free trade. The worst that can happen, it goes up, hits your stop loss, and you break even. All right, so once your stop loss is there, risk-free trade, let it ride, baby. Okay. So as it goes down, all right, again, if you don't have a target price, you could then lower your stop loss to protect profits along the way. And the best time to do that is when you see another pivot point. So it goes down and it goes up, and it hits the 50, comes down, and that's a new pivot point, right? So you could then shift your stop loss to above that to protect. Goes down again, goes up. In this case, it doesn't hit the 50, but it kind of like goes towards the 20, comes back down. You could shift your stop loss above that to protect it, and as it goes up, pivot point, shift the stop loss to protect. So again, you're shifting your stop loss down to protect your profits, right? So again, this was another pivot point that you could place your stop loss there. So the moment it goes up and hits your stop loss, you're out of the trade, and you've protected all these profits from your entry to your exit. Okay, so again, another approach would be to place, to divide your order into half, and you could take profit at 2R for half your order, and the other half, let it ride all the way down and protect your profits, exit when the short-term trend reverses up. Let's take another look at another example. So this is IGT, and let's see if you can identify the short setup. So again, we have got a clear downtrend, all right? 20 EMA, below the 40 EMA, the 50 simple moving average below the 150 simple moving average. So all moving averages in a downtrend sequence. When a clear downtrend, we're waiting for a rally to hit a resistance level and enter as it continues down. So in this case, there we are. There's a rally over there, and you can see it hits the 50 now. In this particular case, you can see it went slightly above there, and then it came back down again, and that's fine, right? It break above and then come back down again slightly. It's fine. Now, question: has this been tested before? Yes, it was tested here. So we know that the 50 is respected, right? So it goes up there, goes up slightly, and then reverses back down. Now, question is, when would there be a valid entry? Could we enter after this bearish candle? No, it's still not safe because it's above the 50. You want to make sure it closes back below the 50. How about this one? Can we enter over here? Now, again, notice this is a pivot point. So this is the first bearish candle that appears after the pivot point. Can we take that trade? Well, not just yet, because this is still bullish, right? The dots are still below the candle. Force index is still bullish, and MACD is still bullish. So we don't have an indicator that's bearish yet, all right? So then we have got this guy that appears. So it's still not bullish. Now, when does it turn bearish? Over here. The force index turns bearish right about here at this point, which coincides with this candle over there, this candle over here, right? So this candle is the one that confirms the short entry. Once it's confirmed, we place our sell order right below the low of the candle against a sell stop limit. And again, if the candle's too long, like the red candle's too big and it's left the station, then you could skip the trade, because again, we don't enter when it's moved too far from the moving average. Or you could use a sell limit order, where you kind of wait for it to retrace slightly nearer the moving average to take your sell entry. Okay, we place the stop loss 1 ATR above that moving average. So again, you have to calculate your ATR, place the stop loss right above there. And again, ensure the stop loss is above the recent swing high. So this was a recent swing high. Stop loss has to be above there. All right, so safely above there, no worries. So that's your 1 hour distance. That's your risk per trade. And again, you could put your profit target somewhere there to take half your profits off the table, and the other half, you could ride the trend all the way down. Take profits when the 20 crosses back above the 40. And again, shift your stop loss down to protect your profits along your journey. So that's the short setup for the rally on the downtrend.